Silver's, I have a number at early next decade of 500, and gold maybe 20,000. So the next cycle is going to be very much a precious metal cycle, a commodity cycle. All the commodities will go through the roof simply because all that money printing, if they do indeed print 20 trillion, that will, with a couple-year lag, start an inflation cycle that's bigger than anything we've ever seen here. We got 21% T-bills and 21% inflation back in the early 80s. I think we could see that surpassed easily in the early 30s, in 2030.
DavidHunter, a veteran macro strategist with over 5 decades of experience on Wall Street, predicts that the next major market cycle, expected by the early 2030s, will be dominated by precious metals and commodities. Forecasts suggest that silver could surge to $400 to $500 per ounce, while gold may reach as high as $20,000 per ounce. Gold prices surged 28% in 2024, reflecting a similar trend in 2010, and continued to rise with an 18% increase at the start of 2025. However, recent market corrections have pushed prices below $2,900. This drop followed the implementation of former President Donald Trump's trade tariffs, causing declines in the U.S. stock market and the dollar, raising concerns about potential economic fallout from increased trade tensions. Despite Friday's slight pullback, gold remains on track for a weekly gain, supported by safe haven inflows. A weaker-than-expected February U.S. jobs report has fueled expectations that the Federal Reserve will move ahead with interest rate cuts this year. As a result, gold has gained approximately 1.7% this week. Silver has shown volatility but is in a long-term uptrend, rising from $12 in 2020 to $32.50. Hunter's short-term targets are $36 and mid-40s, with some suggesting it could reach $75 by year-end. After a 20% surge in 2024, silver gained another 13% in early 2025, totaling a 35% increase over nearly 14 months. Analysts link this strength to declining U.S. interest rates and uncertainty around Trump's policies, driving demand for precious metals to hedge against economic instability. Currently, the gold-silver ratio hovers around 90, suggesting that silver remains relatively undervalued. Silver prices could see further upside in the medium term if this ratio reverts to its historical range of 50 to 70. With continued macroeconomic uncertainties, gold and silver are increasingly viewed as safe haven assets, reinforcing their potential for further gains in the years ahead. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Last week and earlier this week, we had silver down. But I want to remind people, because there's a lot of people who say silver's done nothing. Silver was at its bottom in 2020 was 12. In 2022, it got up to 18. It's now, 32 and a half, let's say, on its way to, I think next stop is 36. After that, probably the mid-40s. And then from there, I'm calling for 75. And these are all numbers for this year. I'm not saying it's, 2 years from now. Silver's okay. It's lagged gold. It has been a little frustrating of late because it came into this year. Basically, it's been flat this year. Flat to down, probably flat to down a little bit. And the miners have been big laggards. So that frustrates investors. But again, it's kind of good timing today because I really think we are seeing the turnaround in both the metals and the miners, and that we basically bottomed out yesterday. So I do think, and by the way, gold has done obviously much better than that. Gold's at all-time highs or very near all-time highs. I have a target there of 3,400 this year, and I wouldn't be surprised if I have to raise that somewhere down the road. But for now, comfortable with 3,400. It's still $500 away, and it's had a nice run. I mean, it's moved up from broke out at 2,100 a year ago or whenever, and you've had pretty much a steady gain all year, all the past year, and so I'm very bullish. Probably my convictions are very high on the stock market having a final big run, as well as the metals having a big run here. Well, before a bust, I'm still calling for a global bust, which I think is bigger than 2008-9, at least financially. So you'll see some ease, not nearly the big ease will come in response to the bust, not before it. But I'm just saying that the Fed will start moving more aggressively to the easing side, both on rates and probably a little bit on QE. They don't want to. They have been very, Powell's been very outspoken about not wanting to go back to, big money printing, what we saw last cycle. So I don't expect them to move quickly in that way. But I'm just saying, if the street gets to the point of saying, hey, the Fed's we've got the wind at our back again, that's what's going to drive this last leg. Ultimately, I think the economy moves into recession, and like I said, could even be entering one now. And stocks can rally in a recession as long as the street believes that the recession's controlled and mild. Where you're going to run into the problems after the top is when the reality sets in that the Fed's been too tight for too long. They waited too long to ease. They're still reluctant to ease in terms of money. The government's downsizing is having an impact. Tariffs are having an impact. And they ultimately wake up and see that the economy is not only a mild recession, it's going to be a much deeper recession. And then move from there into a financial crisis, which causes a bust. So, but for the next, between now and summer, I think any weakness is going to be viewed as positive because it means the Fed could be on board.
DavidHunter believes that gold and silver are poised for a strong long-term uptrend, driven by unprecedented money printing, unlike equities. A potential $20 trillion injection by central banks could trigger inflation, surpassing the levels seen in the early 1980s, setting the stage for a major commodity boom. While a soft landing from inflation remains possible, Federal Reserve Chair Jerome Powell faces mounting risks as he prepares to speak in New York on Friday. A growing global trade war threatens to reignite inflationary pressures, while shifting public expectations could complicate the Fed's efforts to maintain economic stability. The central bank's primary goal in raising interest rates and keeping them elevated was to combat the highest inflation in decades. At its peak, inflation, measured by the Consumer Price Index, soared to 9.1% for the 12 months ending in June 2022. More recently, the CPI for the 12 months ending in December 2024 significantly improved, dropping to 2.9%. However, inflation has risen again recently, raising concerns that the fight against rising prices may not be over. As economic uncertainties persist, gold and silver continue to strengthen their role as safe haven assets. Let's get back to the interview.
I expect the bond market to continue to rally while stocks are rolling over, while metals are rolling over, while most commodities are rolling over. You could see a 0% 10-year rate at the bottom of the bust or at the top of the bond market. And that could be late this year or early, first half of next year sometime. 0% 10-year. We got to 0.4, I think, in 2020, during the pandemic. This would be a new high in bond or a new low in rates. Short rates probably go negative. And the reason for all that is because of, they're gonna be slow to catch on and slow to want to do it because they're not going to want to do what they did last time. They're trying not to repeat the same mistake. But when you're faced with a crisis that's, free-falling financial system, you all of a sudden have to abandon whatever you think you should do, and they will be pouring money in at a rate we've never seen before. We could see the Fed balance sheet increased by $20 trillion. I mean, the Fed balance sheet got to $9 trillion a couple of years ago, last year, I guess, and early last year, and has shrunk down to maybe 7 now. Prior to, when we went into the 2008-9 decline, the Fed balance sheet was $875 billion. So we're now up to, got up to $9 trillion. I'm saying in this reaction to a bust, we could see $30 trillion in the balance sheet, an additional 20 plus. And every central bank around the world doing something similar, just because they don't have any other tool to deal with something that's basically free falling, not just markets free falling, actual banking system free falling. And I could be wrong on that, but that's where I think we're headed. If we get something less than that, it's still going to be bad. But that's kind of what I've been saying this for a while, as you know, that the end of this would end that way. In terms of the precious metals, they'll get hit hard, but not as hard as equities. Probably silver could get hit very hard. If we go to 75 on silver this year, it could easily come back to where we are now or lower. If gold goes to 3,400, 3,500, it could come back to the breakout at 2,100. I wouldn't expect much below that. So, you do the numbers and they're not as big as the equity markets, but still big, still don't want to suffer something like that. The difference between precious metals and equities is that post-bust, we'll have a cyclical bull market in equities, but they won't come close to the highs of this cycle. So, 7,500 on the S&P. Even if you go down 80% from 7,500, you're at 1,500. Even if you go up fourfold in a cyclical bull market, that only takes you back to 6,000. So you'll fall far short of the highs, the secular peak highs of this year. Silver and gold, on the other hand, silver's, I have a number at early next decade of 500, and gold maybe 20,000. So the next cycle is going to be very much a precious metal cycle, a commodity cycle. All the commodities will go through the roof. All that money printing, if they do indeed print 20 trillion, that will, with a couple year lag, start an inflation cycle that's bigger than anything we've ever seen here. We got 21% T-bills and 21% inflation back in the early 80s. I think we could see that surpassed easily in the early 30s and 2030s. So, it's a very extreme forecast, but we're nearing the end of a super cycle that's been in existence since the Great Depression. And that's what happens at the end of super cycles, is everything goes to extremes. So I think that's where we're headed.
As economic conditions remain uncertain and inflationary pressures loom, the outlook for precious metals and commodities strengthens. With central banks poised for potential large-scale monetary intervention and global trade tensions adding to market volatility, investors increasingly turn to gold and silver as safe haven assets. While short-term fluctuations are inevitable, the long-term trajectory suggests significant upside potential, particularly for silver, which remains undervalued relative to gold. As markets navigate these evolving dynamics, the role of precious metals in preserving wealth and hedging against financial instability becomes more pronounced. What are your thoughts on the future of gold and silver? Do you see them maintaining their strength in the years ahead? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.